Hello everyone, it's me, the Boss Hog, and I promised myself after 3 years of investing that I would do a video to see how I was doing. That includes my pensions, my ISAs, and generally how things are going. And I also thought as well it would be interesting as we reach this milestone to discuss basically what got me started, what were my aims, how have I done, did I learn anything, and basically what I'm going to be doing next. I will just say the graph on the right there is my 20-year time horizon, and we're more or less on track at the moment, but obviously very early days. We're a couple of months behind, but we are approaching half a mil with 460k currently. Anyway, without further ado, let's do this. So we're still away at the moment, so I'm in my brother-in-law's home in Warsaw, but hopefully we've adjusted some sound settings and things will be a little bit clearer this time. I'm going to start on terms of what got me started. So basically in January 2020, my daughter was born, and for the first sort of 8 to 9 months, I was busy helping out as much as you can as a man. My wife and daughter were away for a couple of weeks in Poland with my in-laws, and I basically came across two things. The first one, the quote by Warren Buffett, that I think is reasonably well known, but I'm not really sure. I've heard a couple of different versions on this as well. The one I think is correct is if you don't find a way to make money whilst you sleep, you'll work until you die. And I think at the time I just needed to be told that, more or less. But there was also something else I came across, which was a video by a New York estate agent, technically called Eric Conover. He currently goes under the name on YouTube, Eric Van Conover. He's got about 3 million subscribers. He's quite a big channel. But really, it was more about his physical recovery after a major incident had left him, I think, with a broken leg, but seriously beaten up anyway. And it was all about his recovery, getting back into fitness, and the guy is pretty fit. And I think kind of the combination of those two sources sort of started to form an idea in my head that I would like to be both better off and physically better off. However, that was in sort of late August 2020, I think it was, and it did take me about 3 months before I actually got into investing proper. At the time as well, like life was just feeling hard and relentless. I think a few people who subscribe to this channel are parents, so you'll know what it's like. The first sort of few months is brutal. And as well as that, I was also sort of living more or less paycheck to paycheck, which sounds a bit silly. In London, even 130k household income is no small thing. I would say that that's before tax, so it wasn't like that's what we were taking home, but still, we were earning above averages, doing pretty okay. But me and my wife just had a sort of a high spending lifestyle, really. So we weren't investing in anything. Neither of us were particularly familiar with investing either. And we just didn't feel very well off. It's weird because I mean these numbers are pretty decent, especially sort of 4 years ago. But yeah, at the time we just had no savings. We weren't really planning too much, or etc. Also, as well, my wife was recovering from pregnancy and birth. Again, young children are young children; they don't understand anything of the world. And really, I sort of was trying to find something to do with myself. Again, as a man, there's only so much you can do in the early days. I think a father's job kind of becomes more important after the first year or two. And now I'm really involved and I really enjoy it. But at the time, I was also kind of looking for something to do and feeling kind of quite useless, which doesn't really bode very well for me as a man. And was sort of looking for something to do with myself. I'd also say as well that the work I was doing at the time, which was for a subsidiary of BT, but not BT themselves, was nearing completion. It was sort of a 5 year turnaround project where, especially in the first few years, I absolutely loved it. I really worked my ass off. But actually, as the business got closer to being sold, which was the aim of the business, things like just started to happen that were frustrating, and maybe I didn't deal with them especially well. So sort of budgets would get cut or projects would get delayed or shelved. And it was just like difficult. Again, I wanted to do something and I kept on running into roadblocks as sort of, the business got fattened. Again, for anyone who's ever been through that, probably relatable. But I felt pretty useless, to be honest with you. Like, I didn't have money. I could only do so much for my wife and daughter. I was running into roadblocks at work. And also, to be honest, it was one of those things where this was also a time of a certain virus, and all the lockdowns were still in place. So I was also bored out of my mind, and kind of just was like, what on earth do I actually do with myself? So that was sort of I guess, what encouraged me to start reading up, watching YouTube videos, etc. I would say that as much as I mentioned that we didn't have any savings before my wife went on maternity leave, we weren't really sure what the plan was. So we had actually about 50k in savings. It was all in cash savings, just in the bank, not really doing anything. And it was really just in case. Again, it was kind of interesting because my wife's employer at the time, while she was on maternity leave, tried to make her redundant, which is like a problem in the UK at least. So that was also very interesting. And yeah, we were just so I guess it was good to have this as a backup, even though we didn't really need to use it in the end. It also became clear from about September that she would be returning from work to work, sorry, after this, and that there would indeed be a job for her, although it was a different job, it was at the same level and everything else. So that was also something where I started to realise that actually this money was kind of available and it wasn't really doing much in the bank. This was also before inflation and base rates went up, so like our banking interest was just laughable, right? It was like 0.5% or something like that. It wasn't really doing very much. And I guess as part of sort of watching YouTube, reading up, I started to get, I guess I started to understand. It's sort of interesting because I grew up in a fairly poor household, so I had some concepts of things like budgeting. My mum would sort of do shopping lists. She was always worried if we had too much money left over at the end of the month. So it wasn't like I was completely oblivious about money, but I was, I think, oblivious about investments. And a lot of the stuff that I did on day one probably looks a bit amateurish, even to myself, like 3 years later. But I did at least attempt to sort of understand, to start from a reasonable base of knowledge. Even though I can see on reflection I made some mistakes, it wasn't completely like, day trading degeneracy or kind of going after, terrible investments on the whole, although I definitely made some mistakes. Um, but that's basically what got me started. I think it was a case of like reflecting as a man what I was meant to be doing with myself at this moment of time in my life. I think I was like 32 at the time as well, and I was just kind of like, yeah, I was feeling tired, and I just realized I really didn't want to be doing things I was doing until I died, which sort of felt like it. And again, like once you go over 30, your body starts looking after itself in a different way, and like calories don't just fall off, hangovers take longer to recover from, right? Those kind of things, you start to feel them. And I mean, it never got to the stage where I would say it was like a midlife crisis or anything like that, but it was definitely a period of reflection where I was like, what do I actually want to be doing? Um, what does my life look like for the rest of my life, right? Suddenly having, again, a daughter to think about, a wife who needed some TLC, um, a future that needed to be planned for, basically. So a lot of things were sort of read, watched, etc. That was the start of my journey, and I guess with that, I did have some aims, but again, we're just going to have a look at those very quickly before we get into the numbers of it now. But my original aims, as they were several years ago. All right, so in terms of my original aims, it starts pretty basic, basically, which is don't lose it all. Right, I had 50k worth of cash. I guess I could sort of group this also into don't be an idiot or a degenerate, but don't do anything stupid. Again, some people would have no problem with this, but it was actually quite important for me to sort of establish a reputation, I think, with my wife that I actually knew what I was doing, and to somewhat as well, like make sure to myself that I also wasn't messing up here or misunderstanding something. So I did go into it faithfully. Again, I had read up for like 3 months, but I was also quite nervous, to be honest with you, and did start off reasonably small. Though again, I did go from sort of zero to about 40 grand in 2 months, so not that slow. Um, but yeah, that was the simplest one. Just don't lose it all. It felt like it is a big sum of money. 50 grand was about a year's worth of after tax and after necessary cost income. So it was sort of like, we would have more than that in a year, but it would be a significant setback losing that, right? Um, on top of that, I think this is really important. I've discussed it with a few people, but especially if you're sort of in a partnership, whether it's a wife, husband, whatever your family situation looks like. I honestly think getting aligned really matters. For us, we've got a joint income. I have about a 60-40 split with my wife in terms of income, slightly less after tax does its thing. But I think actually even more important than that, like it's incredibly hard to invest if your partner is spending lots of money. And for me as well, like it was an interesting couple of months challenge because again, my wife was feeling quite beaten up, emotionally drained, mentally exhausted. One of the things she was really looking forward to was kind of getting back out there and sort of drinking and eating things that she couldn't eat and drink while she was pregnant, right? And then again, lockdowns got in the way and etc. But then when her husband arrived and sort of said, "Oh, by the way, those sort of Michelin-star dinners that we've been going to, once a month, we might need to park them just a little bit for the future." So, yeah, getting your partner aligned really matters. I would also say as well in terms of performance, it sort of matters. Again, you need them to at least understand and sort of tolerate why you're making them give up things that they would otherwise like to be doing. And ideally, again, you want to be performing quite well. Similarly, as well, like if your portfolio is going through ups and downs, like it kind of sucks having to show them a down month. 1 or 2 months were quite brutal for me, even in the earlier stages when it was generally green. But try sometimes I did have to go to my wife and be like, yeah, I've actually lost 5 grand this month, like not the best month. Like that's a weird conversation to have if you're both new to investing. But I do think generally getting your partner aligned really matters. One of our targets, I actually got this from the Money Guy show. Really recommend them, even though they're US focused and most of my audience is UK. I think a lot of the stuff is quite transferable. One of their wisdoms was, contribute 25% of your income into investments. That became our target ultimately, so that's good. But yeah, 25% feels achievable, but actually not so easy. And for our age as well, that's basically the replacement rate. So if we can contribute that until our retirement, we'll basically have the same sort of standard of life as we have today. So that became quite important as well. Next up, it was about my investments themselves. So if contributing an amount is about contributions toward wealth, right, and then letting the investments do its thing. There was a couple that I had, and in the early days, it was beat the bank, beat inflation, and beat benchmarks, or 8% growth a year if the benchmarks were really bad. That was like a weird one though, and to be honest with you, I think it's much more important to beat the benchmark. Again, you will regularly have down years. People talk about things like 8 and 10% averages, but for anyone who's been invested, very few years are actually 8 to 10%. They're always like plus 30%, minus 20%, right? And even within the couple of years that we'll look at very shortly, which do come into about a 10% average, it's all over the place just in a 3-year period. So I don't think that will change at all. And here I didn't really define my benchmarks because I wasn't really sure what I was measuring against. In the end, it became the S&P 500, the FTSE 350, and the MSC All World Index. So they became my benchmarks as well as the bank and inflation. So, and then checking 3 years, which is what we're basically doing now. So again, 3 years is a bit arbitrary, but and you could very much argue that it's not a long enough time horizon, especially if I look at my portfolio today. It's very much with a 20-year time horizon, or at least a 5-year time horizon in mind. I don't really invest for 3-year periods anymore, but at the time that seemed appropriate. And again, I think it was important. Like if I was doing really poorly against my benchmarks, do I need to just keep underperforming, or do I need to accept that actually I'll never compete with the benchmarks and just call it a day? So 3 years felt, I accept it's arbitrary, but I need to review sooner or later. And 1 year didn't seem long enough, and 3 years, well, sorry, 5 years felt too long. So 3 years was what we settled on. Although I will be doing a review, periodically during my time. And really, the big target here, and the one that the front page sort of talks about in the thumbnail, is retire at 55 with £5 million. So I'm currently 36, so this is more or less a 2-decade target. When I first did it, obviously it was a 22-year target, and that's the target. It's nice that it's all fives. That wasn't on purpose. It just felt like I would want to retire then. And more generally outside of that, I just want to feel healthier, happier, and fitter. That was I didn't have any like big, bold goals. It was sort of just to get myself in order and feel better and etc. So there were a lot of this was focused on sort of wealth building, but there was, and there still remains, at least in principle, a focus on fitness and well-being more generally as well. So those were my original aims. And now, without further fluff, let's see how we've actually done across the last 3 years. All right, so there's a few parts here, 3 parts in total, but in terms of how we did, we're going to start in terms of how we beat our benchmarks. And this is a graph that I've updated, but for anyone familiar with my portfolio, this will look a little bit familiar. However, we've now added both bank and CPI over the last 3 years as well. First of all, we came second. I'm actually really happy with this. The S&P did beat us, but it's been really hard to keep up with the S&P for most of the year. Or most of the 3 years. There was a period where you can see I'm comfortably ahead, but broadly speaking, I feel like I've always just been chasing the S&P. It's just been on fire. About 50% of my portfolio is in either S&P or Nasdaq, or various US indexes. But the S&P itself is the benchmark that I chose. Especially in the early days, I had very little tech. Today I have sort of like much more. So you could argue even the Nasdaq might be a fairer comparison, but I think the S&P is defensible for my portfolio, which I try and make reasonably balanced. But yeah, we're a few pounds behind. The way that this graph works basically is it takes a hypothetical £100 from December 2020 and then basically does a month performance and it's a cumulative. So, you know, if in month one you were up 5% and then in month two you're up another 5%, you would be up sort of 10.5%, right? Something along those lines. So it is cumulative, and there's an element here because of that in sort of sequence of return where the FTSE did a better first year. Sorry, the S&P did a better first year, and then I outperformed it in the second year, and then now the S&P's been ahead as well. So there's sort of a sequence here that's going on. But broadly speaking, I'm really happy with this, especially if I was actually investing purely in ETFs. I would have like fees and things like that, and again, I wouldn't be able to actually directly buy into the index, right? I'd have to buy a tracker of some description. So again, and often they slightly underperform depending on what it looks like, etc. But you know, considering the fact that I did enjoy this and etc., I'm pretty happy with to come in second. Staggeringly to me, bearing in mind I only just put on the orange and the teal lines for this video, CPI here is just absolutely crazy. So I've taken this from the ONS, the Office of National Statistics, done it by month as well, which is what they do it on. So December isn't technically quite here yet, but November is. And I am shocked that CPI is technically the third best performing, if that's quite the right word. Um, yeah, just I think that's ridiculous. You know, like it's crazy what the impact of inflation has been over the last 3 years. So that was pretty shocking to me, to be honest. We did beat it, so I suppose that's that. But I was really surprised by that level. Next up, we more or less have a dead heat between the All World and the FTSE 350. The All World really got smashed in 2022. I guess wars will do that, to be honest with you. Whereas the FTSE 350 is very defensive, commodity based, etc. So actually, it outperformed everything in 2022, and you can kind of see the yellow line there, sort of even beating the S&P 500 and indeed me for most of 2022, the kind of middle period. But it sort of plodded along rather than done anything. So, which I guess is kind of what I would have expected from the FTSE 350, which is dominated by the FTSE 100. But yeah, it's actually underperformed. Technically, it's fifth out of six in terms of performance. So the All World kind of has caught back up, and everything else is kind of comfortably ahead, especially me and the S&P. So pretty interesting there. And then we've got the bank, and I would really say I've been very generous with this. I've more or less sort of plotted about 0.5% behind the base rate in terms of saving rates. I think you would have honestly struggled to get that most of the time. In the UK savings account. Plus, even if you could, it would have sort of caps, access, that all that kind of stuff as well, and I'd have to pay tax on it. So it would just not really compete. But you can see here how rubbish basically having cash in the bank would have been. Again, I think this is quite generous. I think you would have actually struggled to get this level of performance from the bank. From your hypothetical £100, and it starts extremely slow, as we touched on. It only really gets going sort of 2023 as base rates catch up to try and tame inflation, right? So I think this is the best graph I had. I would like to just share one more thing, which is a different way of looking at it. I think technically less accurate, but it's kind of still interesting anyway. I decided to leave 2024 in here just because I think it's fun to look at what's going to be happening next. This is kind of by discrete month and discrete year. So if the previous graph was looking at cumulative, what this does is basically just look at each percent monthly performance in isolation and then just adds it up. So there is no cumulative here, both within year and intra year. And I think the reason why I did this was to try and look beyond sequence rate of return. But it is kind of crude. And it is kind of, yeah, just looking at discrete years, etc. In this performance, I do technically do slightly better, just because, again, I don't have that catch up and the way that the snowball gets going is less damaging. It's also really interesting here as well. Like if you look at me, you know, I basically underperform the S&P in good years and outperform it in bad years, at least in my very limited 3-year data set. Similarly as well here with the FTSE 350, again, it outperformed everybody, right? It was only down fractionally in 2022, but look at how it's basically a laggard in 2023. So again, I guess if you want consistency and you're that type of investor, and you know you're either income or defensive, or maybe you don't like the emotional swings, maybe the FTSE 350 is an okay place for you. You know, you're more or less keeping up with inflation at least over the last 3 years, and you do comfortably beat the bank. There are also some tax advantages as well by having it in ISAs and things like that. So maybe it's defensible, but I think for me personally, I've become quite comfortable with risk, more or less. It doesn't make a ton of sense. And also as well, I think the All World is kind of similar-ish, just less impressive of a performance. But again, a lot of that is sort of influenced by 2022 when it kind of did really badly as well. And then even in the good years, it's quite comfortably behind both me and the S&P 500. Basically, the S&P 500 has outperformed everything. So even though there is a closeness here, it still is the S&P winning overall. Um, I've got a little asterisk here for 2021 because it does include December. Similarly, as well, 2023's got a cutoff sort of just before Christmas. But there's, so this will update technically, but I think we'll do this as our 3-year cutoff. I'm recording this on the 26th, just before the US markets open, so it should be more or less 3 years, and I'm happy to do the cutoff now. So in terms of beating the benchmarks, I guess we didn't beat the S&P 500, but we did beat everything else. And again, broadly speaking, I'm actually pretty happy with that. The S&P has been difficult to keep up with, and I've enjoyed sort of discovering gems, and indeed even making mistakes, if enjoyment's quite the right word, but learning hopefully from that as well. And we'll reflect on more of that later. But let's have a look at some more of the performance data next. All right, so part 2, how did I do? I'm going to do highlights and lowlights now, and I decided to pick 3 from each. This is a weird one because honestly, I didn't really make a ton of money here. The reason why this is such a highlight for me is I sold out of JD Wetherspoons for the right reasons. It was quite early on in my investing career. I'd been in it several times before, kind of scalping, and I'd bought in for something like 11.20 per share. And after the results, the shares actually went up within the day to about 11.50. And when I looked at the results, honestly, I was shocked, and I realized I'd misunderstood the thesis behind JD Wetherspoons. I think the market had in general. That's why I think it went up a couple of percent when the results were published. And by misunderstood, I at least was looking across at other competitors, seeing how they were recovering after lockdowns, etc., and just assumed a read across to Wetherspoons. But Wetherspoons' pubs are quite different to many of their competitors. They need a lot of volume. They're a bit different in terms of food and drink sales. They just are in different locations that were recovering less quickly. And if I look at the share price today, I mean, I would be down like 40-50% on that position. It's recovered a little bit, but still, I mean, I'd be deeply in the red from here. So even though it wasn't really worth anything, especially the final trade when I basically made like a couple of quid profit on a kind of half, I think it was a percent by the time we were done with transaction fees and everything else. But I think I was most pleased because it felt like the first time that I truly felt like an investor. I'd got slightly ahead of the market. I admitted I'd made a mistake to myself, put it into Discord as well. And I was just really pleased that I'd acted in a way that I think an investor would and should. It was the first time I felt really good about being an investor. Next was the first time I really saw a 4-figure win in a day. And again, there was an element of justification here where I'd found a chemical company of all things that I found exciting, and it was undergoing an evolution, a revolution. It was changing itself. And I think I got ahead of where the market was basically in terms of knowledge. And one day, an activist investor took about an 8% share in it and said, fundamentally, he just believes it was significantly undervalued. And at the time, it was, I think, my second largest position. I had like 24,000 in it, something like that. And it just shot up massively. And, I was like, this is fantastic. I sold out between $34 and $36 and, ended up making sort of a 50%, 40% profit overall. Once FX fees and everything else was adjusted for, but yeah, it felt really fantastic. And yeah, one day when this was first announced, it went up like 4,000, and although I didn't quite time the maximum because it did end up going up to about $42, I was personally happy selling out when I was. I had a $36 buy price, so when it went sort of 34 to 36, I just sold out in a couple of tranches. I didn't want to be greedy. And after it did go to 42, it actually came back to like 24. So I am now back in Huntsman, and I am down about sort of 15%, about £1,000. But my overall profit on Hunt is significantly green. It's one of my best performers, second best performer of my whole portfolio. And yeah, it just felt great. I mean, it was so exciting to see this news and to just see the numbers and to realize I'd suddenly made like thousands in one day. That felt great. It's difficult to describe that feeling, but it is there. Next was, again, I guess I did feel like an investor with this. So this is National Express before they rebranded as Mobica. This is a UK primarily travel company, although it's sort of in Iberia, America, Germany, etc. And it does primarily do coaches, but it also does buses, trains, and so on. Um, and I was into National Express as a recovery play after lockdown, and at one stage it was my largest holding, and I sold out between sort of well, about 260 as an average, but between sort of 240 and 270. And I bought in about 218, or that was my average, although I'd been buying in a lot higher and sort of riding it down. But the reason why I sold out, and I sold out very green, again, it's like my third best performing share of my entire portfolio, um, is I started to see it wobble. Like the revenue and profit started to disconnect, hedges started to drop off, inflation pressure started to arrive, and I just lost confidence in the business. And again, I mean, if I'd have held on to this would be like down 10 grand, potentially more. It's been through a really rough patch, and I felt like again, I could have timed it slightly better, but in the scheme of things, I felt good. Not only here did I realize a good amount of win, but I saw it, I think. And every time I have a look at sort of Mobica, it just looks a bit lost at the moment, like it's lost its way. So yeah, I feel like I'm more or less maxed out, as good as I could have got without the benefit of hindsight. And just felt really good realizing that, and realizing again I escaped a potential banana skin. However, I definitely did find a couple of other banana skins in my lowlights. So I'm going to start with arbitrary sells. Like if I've just described a couple of instances where I felt like I was making smart investment decisions, selling out of Broadcom and Sage, which is a UK-based accountancy firm. Basically, you can sort of think of them like almost like a Workday or one like an Intuit maybe. But they're a really good little business, and they are kind of an accountancy software for many small to medium businesses. Sage is a solid system. I've used it many times in my work, and I got great buy prices on both of them, and I just sold for like 20 to 25% profit because it seemed good, and my long-term average was like, target was like 8%. So I was like, brilliant, this is 3 years of profit, right? And that was really it. Like there was no good reason to sell out of either of these companies, which have both just gone on to excel massively. Like Sage, I'd be up about 120% plus dividends. Avco, I'd be up about 160% plus dividend. Just silly. Like they're both really key companies, and just I regret it, of course, and cost myself here many thousands in terms of opportunity cost. So yeah, don't sell for arbitrary reasons. Don't just pick a number and do there. By all means, pick a number and be like, okay, does this make sense? Let's review this now, right? Has anything changed from the business? But if anything, both businesses were just getting stronger. So for me, it was deeply frustrating in hindsight to look back at this. It felt fine at the time, but now, as a sort of more seasoned investor, if I can call myself that, it seems very silly. So don't sell for arbitrary reasons. By all means, give yourself sort of either a day or an amount where you review things. But again, just update your assumptions, update your numbers, and then if there is a reason to sell, right, like there was with JD Web Experience, then sell by all means. Similarly, as well, if the business is improving, especially Sage, I think Sage has really transformed itself into sort of a software business, a truly software as a service business. But Broadcom as well as an incredible company for anyone who's got exposure to it. And yeah, I should have gone heavier into both rather than the opposite, which was an arbitrary sell. I'm also going to pick here, like, this is a general, but it really applies to me for Polymetal and Evraz. These are two, or were two UK listed miners, primarily with Russian exposure, although they also had exposure in sort of Europe, Canada, America, and Kazakhstan. But generally not giving enough non-financial considerations. Both of these companies seemed good on paper when I was buying them. Evraz especially was a very high dividend payer and had been for many years. It wasn't like it was just throwing off money basically. It was a very high yielding stock before anything became a problem with its share price and anything like that. But the invasion of Ukraine destroyed both of these as investments. And to be honest, I probably should have got away from both of them in terms of financial risk. Like when I heard some of what was being discussed in terms of people's like rights to exist and states that were sort of artificial, like I'm enough of a student of history to realize what that means. And that basically, like, as soon as one person or country refuses to recognize the rights of another group, it inevitably doesn't end well. But in general, like, I mean, I was in like Baba for a short while and sold out more or less at cost. And again, that was a good decision. But I learned my lessons here. I was very sensitive when sort of things started to wobble with Micron and sort of semis in general. I'm always kind of mindful about political risks. So I think there can be such a thing as a good company in the wrong location, or the wrong time, and etc. And I should have been smarter about this stuff. It's hard to predict things like outbreaks of wars and things like that. It's everyone's surprised until they're not, and it always seems almost like inevitable. But I would just generally group this as one higher and say just not giving enough considerations to the non-financial reasons, right? Again, I would count Alibaba as a great example where if that was a company in America or somewhere else, it would look very different as an investment. But as it is, you've constantly got the threat of kind of autocrats and the whims of the day, and indeed geopolitics, right? So that was a lesson for me that hopefully I've learned from. A very expensive lesson as well. Like that cost me about 8,000 when my portfolio was only about 120,000, even slightly less. It was about 9% of my portfolio just got wiped out, more or less overnight. And I've had to crystallize Poly for a massive loss, and Everaz at the moment I'm down 80%, and it just sits there as a reminder of my mistake in my portfolio because I can't sell it even if I wanted to. And and I put making genius moves here in speech marks because my massive profit that I made from Huntsman more or less got destroyed by moving it into Genius more or less at the wrong time. I still actually hold Genius, but it's my one legacy SPAC that I hold. I did think about selling this and did come very close until I went on an investor day about 2 years ago and was convinced to keep. My mistake here was basically just forgetting about valuation. I don't think I'm very good at valuing kind of non-profitable early stage companies. I got into this because it kind of bridges big data and gambling and content and media and gaming. And I do think it's got a lot of potential in the future, but my mistake here was buying at the kind of prices I was buying at. And it just, again, I forgot about valuation. I forgot to kind of go into a company slowly. I just basically had a big sum of money and was like, oh, I recognize this as an opportunity. But it was not the best opportunity. Again, the timing was wrong and the valuation was wrong. And I'm still to this day down about 25% on my Genius position. I do think eventually I'll make money on it. But this is a huge, like, a big chunk of money sitting in my account, about 10 grand in my account, so not a trivial amount. Still tied up in Genius and still 25% down. So even though 2024 should be the year when they start to make money, it's going to take me probably a couple of years longer before this turns green. So yeah, here I just forgot myself and kind of operated outside of my areas of competency, burned through a lot of the profit that I'd made with Huntsman, and it was just I don't quite want to call it as silly as the other two, but it was a mistake. Again, the valuation was not where it should have been for me to be taking such a bold move, and I should have just gingerly gone in, buying a couple of shares a day or something. Would have been a much smarter way for me to sort of channel 10 grand into a money bit. So those are some of my highlights and lowlights. But yeah, I picked those three. I've definitely got a few more as well, but those seemed like my top three of each. So I thought that would be interesting to just recount. And then we're just going to do a part three next in terms of some of the quirkier things that have happened during my 3-year journey as well. All right, so part three, how do we do? I just wanted to do some fun stats. A few people that I kind of ran some of this data through in Discord for this was a bit of a waste of time. Maybe it is, but it's my video, so I'm going to do whatever I want. And I kind of find this stuff quite interesting and fun. Anyway, so we're going to start with our best day, which was the 9th of March 2023. More funny, I think, is actually our worst day here, minus 4.6k. Now, interestingly, this is when you had like Silicon Valley Bank and all of the worries around that. But I did find it really interesting that my best and worst day are literally next to each other. So, the 9th was apparently amazing and the 10th was apparently dreadful. And it just goes to show you the swings that you have to endure. In terms of my best win streak, this is actually still ongoing. So we're up to, like 13 days at the moment. And together it comes to 13,500. So that feels really good. This is beating my previous best streak actually now by 2 days. And we'll just basically keep on going until we hit the red. I know it's going to happen sooner or later, but it's still enjoyable. My worst loss streak here is smaller, but still pretty nasty. And interestingly, there's a day here that if I didn't have that day where I made about £50 on the 6th of August, it would be significantly bigger. It'd actually be about 13,500 and 3 extra days. So if it wasn't for that day where I eked into the green, it would have been an even longer streak than my greenish streak. By a day, but it's interesting. A few people will ask sort of why I do some of this data. First of all, I just love numbers. So there's that. But I also think like when you're feeling beaten up or when you're sort of prone to exuberance because the market's very green, looking at data can kind of restore some sanity. And for me, again, when I first started collecting this data, it became really important. Now, in terms of my day data, I only have from February 2021 when I started doing it, but there's still a couple of really interesting things here. So this is all of my days, right? 713 days across that time period. And surprisingly to me, most surprising, I think, is that only 52% of those days were green. Like, it's pretty close to being 50-50. And when you actually look at what that means, 373 green and 340 days red. This is basically a plus day streak and a minus day streak, so they kind of read as opposites. And you can kind of see, right, 373 here, 373 here. And you can think of it as the reverse as well. Like a positive day streak being zero means I was red on that day. So that's why the total here is that. So that's the first interesting thing. Secondly, like although over that period of time my profit's 24,500, look at the red totals and the green totals. Like if when you forget about this, like now because the market's green and everyone's having great Christmas, Santa rally and all of that. But when you're actually in like the middle of a hurricane and the market's beating you up, it does feel relentless. And like when I saw this, like actually I've had 308,000 pounds of red days. Like that is pretty brutal considering the size of my portfolio is, 170k. Similarly as well, my total green days, right, 333,000. That feels really good. And again, when you're in the middle of a win streak, it feels incredible. Um, but this kind of reminds me of like the opposite way of how casinos work and how gambling works, right? Like this is the right kind of ratio for things like a blackjack table, where you'll definitely win a lot of blackjack hands, and you'll have sessions where you'll walk out with more money. But I can imagine these sort of numbers from a pretty serious gambler. Especially over a 3-year period. So this would definitely be enough to get you comped a few meals. But yeah, this is the sort of margin that casinos are working on. If you're playing reasonably sensibly at a sort of reasonable table game. So I thought this was all interesting in essence. But yeah, it's also really interesting as well in terms of the streaks. And the way that like the one day of each streaks and the 2 days are actually pretty close. Like you're not, it's close. You apparently you have to go into quite big data sets and quite long periods of time for the market to sort of give you the green in the long term, which I know is meant to happen, but again, it's hard to see that when you're being either beaten up or flattered, because by flattered I mean sometimes the market's so green everyone looks like a genius. 2021 was probably that. And in other times like 2022, it's really hard to do anything right, right? You're basically minimizing losses. It's brutal. So this is all just interesting to me. And again, when you're sort of operating above the data, it starts to feel more cold. But by that, I mean it starts to make you feel okay. Because if I have a bad day, I just look at this kind of data and think, oh, it's okay, it's just a bad day, it'll be fine in the end. Similarly, as well, if it's been green recently and then it starts to turn red, it's almost a case of, oh, it's fine, I was expecting it. So good fun. In terms of contributions, which I only started doing properly in 2023, I would say, really to get the data. I was trying to do it, but I was just a bit naff with my data. I've only really gotten a grip of it recently. 2023 though does look really good, so I've calculated this as 34%, but it's a bit flexible at the moment because my wife gets her bonus on the 29th of December. I'm not really sure how things like taxes, her pensions, etc. are going to work, so I've used some googling. I've ran some numbers and I think this is reasonably correct. Either way, however, we've comfortably smashed our target and I'm really pleased with this kind of ratio. It's just going to give us such a stellar retirement or potentially allow us to bring our retirement forward at several years. So I'm really sort of proud of myself and my wife. And I can't really say much more than that. Like 34% just seems like it's such a smash. I almost feel like the target was too easy. But again, I'm really proud of that number when the markets can perform or they cannot. But actually, this is the hard work, the where we're starting that snowball and etc. So yeah, I'm super pleased with that. There's no two ways about it. Next up, I will confess that my health and fitness is very much a work in progress. I've gone through stages, but I've never been truly in great shape. I went to like a military school and I was in fab shape, and then I went to uni and I gradually lost it all, and I've just never really picked it up since then. It still feels like very much a work in progress. I've sort of stabilized, I think, my worsening health, weight, that kind of stuff. Sleep has gotten better as well. over 2023, but it hasn't really improved and recovered in the way that I would like it to. So that's very much a work in progress. That's quite diplomatic. I'm a bit disappointed after 3 years. And similarly as well at well-being. Again, if I think about things like reading or thinking, frankly, communicating with friends, family, etc., it could all be better. So I guess as much as I'm really pleased about my financial contributions, I'm really disappointed with this stuff, where it hasn't really progressed, especially well in 3 years. I will say that again, 2023 on both points feels like a stabilization year, where it hasn't gotten any worse. So that is something. But now it's important that I build on that something for the next couple of years and kind of, really uh, progress on those points. So next up, in terms of what I learned, there's maybe some cliches and some obvious things in here, but there's also, I hope, some reflections, and I think all of them are worth talking about. I'm going to start with a really obvious one in hindsight. It's really difficult to beat the market. My wife's had restricted trading for over a year now, so it's a little bit different to how it was in the early days when I could pick and trade and swing trade, especially anything I really wanted. But even then, it was super difficult to beat the market. And I guess it's meant to be. Like the data shows, like the 3 year periods that I was looking at, depending on the market and the period in time, usually individuals, and this includes fund managers and things like that, they underperform the market across a 3 year period of time about 75% of the times. That was kind of the number. So, even experts, which I think is rubbish on reflection, I don't think there are too many experts. There are a handful for sure. But I'm obviously not one of them. So again, I'm quite pleased to beat most of my benchmarks and be just fractionally behind or modestly behind the S&P 500. But yeah, even when I was like really paying attention, reading up, on individual kind of obscure companies that I'd never heard of before that point, it's super difficult to beat the market. I think you have to take it quite seriously over a prolonged period of time to be good. You have to know how to read financial statements. You have to kind of be focused, quick. Often, again, if I look at JD Weatherspoon's, that was like if I'd have waited on that, it would have cost me more money. It's just hard to beat the market. Like we need to be honest with ourselves. This for me was a big surprise. I've spoken about this a few times because, as a poker player primarily, I'm used to kind of losing money. Although I'm a winning player, I've got a lot of data with my poker. I do sometimes have sessions where I'll return with no money, just as I'll have sessions where I'll return with a couple of thousand. Um, I think the difference is that investing, you can feel so powerless, like just a leaf on the wind. You're making the right decisions, you're doing the right things, and you just get absolutely torn apart. It feels brutal. Again, having to like look at these numbers, there have definitely been days where I didn't enjoy logging into my brokerages or having difficult conversations with peers or my wife. I found it really difficult, to be honest with you, much harder than I would have expected beforehand. And I thought I would personally be much more resilient, frankly, than I have been at parts. There have been parts of my journey where I really didn't enjoy it. Probably the worst feeling was, again, the Russian invasion of Ukraine, which don't get me wrong, I don't mean to dismiss the dreadful events that are happening in that country, and indeed those countries. But for me, the impact it had on me personally was just horrible. The cost just destroyed all of my profit and then some, and just didn't feel good at all. So yeah, I think that's something you need to be mindful of. Maybe you're not that way inclined, maybe you're worse than me, I don't know, but it's definitely difficult. Um, I've touched on this before in terms of being aligned, but I think it's so much easier with a supportive partner. That could also necessarily include sort of family. Maybe it's your mum and dad, maybe it's a sibling, just somebody who you can kind of talk to, sort of bounce ideas off, kind of de-stress and vent a little bit, maybe. But I think it's good to have somebody else who you can talk about. And as an extension of that, so I talk about it with peers. I think like Discord, and like I'm in Paul Briscoe's Discord quite actively. That's been a real help for me, and I think it's been helpful for other people as well. It's especially helpful when you're either celebrating wins, so things like dividends, or when the market's great. But I think it's even more helpful when you're kind of laughing or observing or kind of trying to make light of difficult periods, red things, worse performers, mistakes, market being brutal, like just realizing that you're not in it alone makes it so much easier than I think it could otherwise be and feel. Again, talking about geopolitical risks, much of the world is unstable. Like I'm in the UK, it's pretty stable, although it could be better. Europe in general is similar, and America is, I think, I do buy into American exceptionalism, to be honest. I am largely an Americophile. However, I think again it's easy to forget that most of the world isn't as stable as the UK and America. And I think it's smart to not downplay political risk. Even like good companies, like if I pick one off the top of my head, like Airtel Africa, that's a solid company, I think, and an interesting opportunity as a stock that I don't own. But again, it's got a lot of political risk. It recently got beaten up for a devaluation of a currency, and you could pick miners, IT companies, telco, infrastructure, etc., and realize that a lot of it does have exposure to political risk. So don't be terrified of investing, but just be smarter about your allocation of risk. Definitely don't ignore it. Put a premium on it or spread yourself, so that you're not committing too much to more riskier plays. Again, even if the numbers look good on paper. I came across this way too late in my investing journey, to be honest. Probably not for the first year. Um, this kind of feels like a Peter Lynch thing, to be honest with you. But again, know why you own something. I think it's perfectly okay to work out what kind of investor you are, whether you're a value or dividend or growth or speculative or high risk or low risk. It doesn't matter. And you can be a mixture of those things. I think honestly, most people, at least to some degree, are a mixture of those things. But just know why you own each stock, know the kind of person you are, and sometimes you do have to be confident in your convictions, but at the same time sometimes you have to reflect and sort of revisit and potentially realize that you were wrong. So I think it's like, don't be stubborn in your convictions, and again, be honest when you make a mistake. But at least know why you're actually in each position. And it sounds obvious, but actually it doesn't feel obvious when you first get started. Again, I think this is super important. Be humble. Again, I think this is something I've been okay at, to be honest with you, because again, I started this whole journey realizing that I didn't know everything and wanting to learn and be better. So that was kind of okay, but still, it sucks having to realize that you made a mistake, especially when you realize it too late. And it's cost you. It's kind of okay making a mistake, like with Weatherspoons, where it's like, oh, sugar, I shouldn't be in this investment in the first place, right? Let's just sell out of it quick. But there have been other things where I didn't get it right. And again, things that I shouldn't have been invested in because I just don't really know enough detail or enough knowledge in some other way. Those are mistakes. And I think it's okay to make mistakes. I think it's expected. But I think you have to be humble enough to kind of be like, yeah, I messed up there. And hopefully you learn something from them. And again, this is a bit cliche, but I think it's important to say as well that like any progress is still progress. Like again, if you're 25 and only contributing 5% of your income into investments, honestly, you're crushing it. Like I had negative wealth until well into my mid to late 20s. Um, there are times when it feels like I'm just treading water or hardly going anywhere. But again, just try moving forward. I think it makes a big difference. If you make a tiny bit of progress, it is still progress. It does feel like you're going somewhere. And I've seen a lot of like compounding be discussed when it comes to financial, but actually I think life compounds as well. Like I've seen a lot of people kind of screw their lives over across a number of years, and it gradually gets worse until they're in a hole. Likewise as well, again, I grew up pretty poor. I used to see people just snowballed into uh, impossible debt traps, and you could never recover because debt also compounds, as do mistakes. So as long as you're making tiny improvements, I think that's the real thing, and that can be sort of financial or wealth or etc. And again, as much as I was critical about my health and fitness and well-being across 2023, it was still progress compared to 21 and 22. So I think like again, there is some progress being done there. The important thing is just to keep building off that because even if you're only making like a couple of percent per month or per year, we've all seen what that does in terms of portfolios over a long period of time. So you just have to keep going. And so again, as much as this is cliche and trite and maybe saccharine, I think it's important to say that as long as you make a little bit of progress, you should be really pleased with yourself, especially if you're just getting going or you've been through a difficult period. Like if you can honestly still move forward, you're doing great. And that's sort of how I have come to feel. And I don't, I want to be clear, like not every day did I make progress. Some days, again, I just didn't want to open my app or felt horrible or, put things off that I really shouldn't have done, especially procrastinated. So I don't want to come at this like I'm some kind of like influencer or saint or anything like that. Like I've got so much still that I would like to be doing. But when I look at the 3 years, like my situation is so much better today than it was 3 years ago. And I think that is kind of a really important takeaway and where I feel most pleased. Like if I hadn't have done this stuff, if I hadn't have been through the last 3 years, mistakes and all, I would be in a worse position than I am today. And I guess I am happy and proud and everything else of that. And it's now just important that I kind of live this and continue progressing, right? So I guess next up, and to wrap up, we're going to look at what I'm going to be doing next. All right, so in terms of what I'm going to be doing next, the first one is something I've started to do from November, and I hope to do this on a monthly basis. But it's basically getting a better understanding of income and expenses. Again, I just haven't really gone into the detail because there was so much bigger things to be fixing, but now we fixed a lot of the bigger things. Now it's time to start getting into the details and again driving down those expenses. 2023 was a very expensive year for me. Likewise, inflation is inflation, and looking at how we can do things better, I think still matters. So that we're going to be doing that and continue to do that and hopefully improve over the long term. Also, as well, this is an arbitrary number. I've definitely pushed myself by trying to contribute 100k into our wealth in 2024. That compares to 80,000 in 2023. Which again, that wasn't like we wasted a ton of money, but there are a few reasons why I am somewhat optimistic. So first of all, I didn't get a bonus in 2023 because I changed jobs and didn't qualify. That will be very low, 5 figures, I suspect. My wife also just had a pay rise of about 20%, so the take home from that will sort of be another 7 to 8,000, something like that. And then we sort of hope to make the remainder by sort of improvements elsewhere, but we will see. I do think 100k is ambitious here, but I'd rather go into the situation where I fell slightly short of ambitious targets than smashed easier ones. And I mean, the 80k in 2023, the target was actually 70, so it sort of feels like it was too easy. Um, but yeah, so I mean, all we can do again is try and pick a number. 100k feels tough, but we're going to go for it, and hopefully we'll be able to build on 2023. But because yeah, I mean, if we start to contribute 100k a year, we're going to be a couple of years ahead of our target and sort of doing great basically. So that'll feel awesome. Within that 100k, the most important thing, because we want to retire early and we want to retire well, so we're looking to avoid tax in our retirement, is maxing out the two ISAs. So that's 40,000 a year, right? My wife and me. Next up, this is most important for my wife, who's kind of been slow but deliberately so on pensions and pension matches and things like that. So I currently do 8%, which is my employer max. Although I'm hoping to negotiate a slight improvement in that next year, so we'll see. But also my wife as well is an opportunity for her to start really matching and being a bit more aggressive with pension contributions. Also, we've been overpaying our mortgage by about 15% since the rates went up, so I think that's a good thing to continue to do. And now that we've kind of gotten used to that overpayment, hopefully we can continue kind of not noticing too much. This is also quite a big one for my wife, so she's really keen on continuing to overpay. So, and especially now with the rates where they are, I think it makes a lot more sense. So we're all for this basically. Next up is build up premium bonds, and this is kind of one of our emergency pots, but also kind of is tax efficient and isn't impacted by the market. So there's an element of stability there. So at the moment, a lot of our assets are basically influenced by the market, either pensions and ISA, which is financial markets, or my home equity, which is the housing market. So it will be nice to have a little bit of stability in that. Also, as well, become more rounded in my investments. So everything I've just mentioned above, but also I want to be really making sure that I don't have any gaps in sectors, regions, or exposures. So making sure that I have things like, consumer discretionary or utilities and infrastructure, those kind of things which aren't particularly sexy. But I think, again, now that I have so much exposure to the markets, I think it's important to become more rounded within that. Also, as well, sort of as an extension of premium bonds, but more generally speaking, build up a proper emergency fund worthy of the name. I've never truly had an emergency fund, so that's not a trivial amount of money for us. It probably needs to be in the sort of 35 grand region to be a proper 6-month necessary costs sort of bucket. But again, I don't really have a ton of detailed data. See the first point. But I think I need that sort of figure, and at the moment, we're at about 6, so we've definitely got some work to do there. But that's going to be one of our focuses in 2024. Similarly as well, just as an extension of non-market exposures, so that's also sort of offset mortgage and that kind of stuff. And also things like insurances, wills in place as well. Like again, we've got a young daughter now. It would be dreadful if anything happened to either of us and if things weren't clear of what was going to be happening. And again, I've been through the kind of bereavement process, and it's stressful and difficult, and we need to get our lives in order should anything bad happen to kind of minimize the hurt and the admin, frankly, that comes with somebody's passing. So that's a big focus as well. And then try to keep on top of life admin. Again, this could be so much better. There's stuff where I've procrastinated. There's stuff where I've just prioritized other stuff. But if I'm really honest, if both me and my wife, but myself to more of a degree, we could be a little bit better with life admin as well. So I'm not quite sure how I'm going to measure that yet. But generally, I shouldn't have stuff outstanding for months and not making any progress on it. And then I guess, at least for now, try and keep on top of health, fitness, and well-being. Again, I've talked about 2023 being stabilization year. That's fine. It's at least an improvement on previous years, but then it's important that we build from that. So that's going to be the takeaway here. And then just to round off everything, we're also going to commit to doing another one of these reviews in 2 years. That'll be a 5-year review. Hopefully, we'll still be performing reasonably well. And if anything, I'll be looking very buff and toned because I'll be incredibly on top of my health and fitness. I'll also be very zen and not stressing about market movements and things like that because my well-being will be so top-notch. But we will see what the next couple of years hold. Obviously, I haven't got a crystal ball. We'll just try our best. And again, try and progress a little bit by a little bit over the next couple of years so that we can reflect with some pride. But I guess just to round everything off, thank you very much, everyone, for the 3 years that we've had. It hasn't always been easy. I haven't been super consistent in my videos. I realise that. But I'm pleased that everyone has taken time out of their days to watch me. These kind of videos do help keep me honest and focused, and similar to what I was talking about earlier, kind of give me things to talk about, to keep myself accountable, to use you guys as a sounding board. So actually, I really appreciate it. And I guess, yeah, I'll see you again for this video at least in 2 years' time. Thanks very much for watching, everyone. I've been the Boss Hog, and good luck with everything. Bye for now.